All right. Well, thanks everyone for joining the Bond Bank's now semi-annual municipal and economic outlook or municipal update. But in the case of the one that occurs at the beginning of the year, it's also our economic outlook for 2024. We are so excited and thankful today to be joined by Betsy Kine, who is the head of municipal capital markets at Stifel. Um, that in its own right is very impressive, but perhaps even more impressive is that she spent time at the University of Vermont. So is a great person to join us as we are the Vermont Bond Bank. Format today will be Betsy will provide a market update and followed by some Q&A from the audience to the extent it exists. I will feel free to put that in the Q&A function within the panel at the bottom of the screen. This will be recorded and up on our website. And then please stay tuned for the next event. For folks that are in the investor community, bondbank.org/investors. We regularly put our municipal bond offerings up on our website so folks can stay aware and up to date on bonds we might have coming to market. So with the advertisement over, I'm very happy to hand it over to Betsy. If you could just tell folks about your role a little bit more at Stifel, and then we can jump into the presentation.
Sure. Well, thanks, Michael. Good morning to everyone. It is very exciting to have this opportunity to talk with you and provide a market update. I have been part of the Municipal Securities Group here at Stifel since 2011 and an underwriter in the market for 17 years now. So, I think certainly what we've experienced over the last few years makes for interesting times. And I think our ability to navigate that here at Stifel is helped by the fact that we are in the market so frequently on a daily basis with issuers all across the country. So our ability to take that real-time information along with investor feedback to put together, pricing strategies and recommendations leads to efficient market access. I'll go ahead and share my screen, or maybe Michael, if you want to share your screen with the presentation, it looks like you might have to enable me to do that, and then we can get started. My thought here today is we'll take a quick look back at 2023, looking at the market in total, looking at the technicals in the municipal market, and then, take a forward, a look forward as to what we expect heading into 2024, and then the economic outlook. Michael, maybe you can just give me a thumbs up. Do you see the presentation?
Yes, the presentation's up on the screen.
Okay, fantastic. So we'll get started here. You can see a snapshot of what I just described. And again, thanks so much for the opportunity to talk to you. As Michael mentioned, I am a graduate from the University of Vermont, so it's great to kind of come home, if you will. Looking back at 2023, volatility characterized the Treasury market, translated into a defining theme within the municipal market. The market continued to focus on and react to Federal Reserve policy. After being slow to react as inflation continued to move higher, the Fed increased rates by 11 times beginning in 2022, including 4 25 basis point moves in 2023. Inflation began to ease after peaking at 9% in 2022, but still remains elevated and well above that 2% target. And so, therefore, the market reaction to economic data continued to be heightened. You can see the top chart, chart of this page, right? The number of weeks in the municipal market where we saw yields adjust by 15 basis points or more. And that was elevated through 2022 as rates were moving higher and continued through last year. For context, I added in both 2020 and 2021, where 9 out of those 10 weeks in 2020 were following the uncertainty and the COVID shutdown. But then we only had 2 weeks in 2021 where we saw those weekly movements in excess of 15 basis points. So in a normal market environment, stability or relative stability is often standard operating procedure. However, as you look at the bottom graph here, despite this unprecedented volatility and rate movement, there were windows where we had seen an equal, if not greater, adjustment to lower yields. And so, providing a strong backdrop for issuers to access the market with a good bit of flexibility and our ability to be nimble and to take advantage of that. The technicals of supply and demand continued to be paramount as we saw to the direction of municipal market movement. And so as we look at these pockets of rate movements, right, as we began 2023 through January and February, we saw supply really slow, right? We started the year with new issue supply well below the average. January, it was 17% below January of 2022. February saw new issue supply even lower than that, 40+% below the previous year. And so we saw really the demand component kick in and move us to lower yields. Municipals turned somewhat more constructive in March, only to be challenged then by the banking sector challenges, debt ceiling debate, and caution returning to our market overall. So despite new issue volume through the first quarter being reported down by 20%, the windows of opportunity and issuers continue to access the market were what we were focused on in putting together those strategies. I would say throughout the year, the intraday volatility, as we saw Treasury market movement really is the driver for municipal market movement, continued to be what we were navigating. And then as the Fed took a pause, right, their last 25 basis point rate move higher was in July. As we saw the Fed take a pause, despite the mantra of higher for longer being the message, we really saw that take hold after the last Fed meeting at the end of the year. And you can see this pretty significant move towards lower rates November through December. As you look at this 10-year municipal market data yield curve, we started the year at a yield of 264 on 10-year municipals. We peaked at a 361. And then we ended the year at a 228, the average rate exactly where we started. And I think if you would have asked anybody the direction of where we thought rates were going to go throughout the year, you'd be hard pressed to suggest it was going to be largely unchanged in a full roundabout overall. Looking ahead here on this chart, I mentioned it's just additional context, if you will. You've got the blue line, 10-year Treasury yields, the green line, that municipal yields, as I just referenced on the last page. And so while the municipal market not directly correlated with the Treasury market, we continue to take our cues from there. So we move directionally most often with our counterparts in the Treasury market. Headline risk, the driver for that intraday volatility throughout much of the past few years. And that's a theme that continues here as we begin 2024. The Fed's aggressive move towards higher terminal rates put pressure on Treasury yields and further put pressure on the municipal market. Only did we move lower on recession fears, the banking crisis in March, debt ceiling debates, as I mentioned. And then after reaching the highest levels we've seen in the Treasury market and the municipal market, going back, to the financial crisis, did we see rates moderate lower with the idea that perhaps we were ready to see the Fed take a pause as we begin 2024. So as we look specifically at the technicals in the municipal market, as we saw record supply in 2020 and 21 as rates were at record lows. So understandably, issuers taking advantage of that favorable rate environment. We also saw taxable issuance increase as many issuers were refunding bonds in the taxable market as advance refundings of tax-exempt bonds was no longer available to them. You know, supply slowed as we made our way through 2022 and 2023 with an exceptional fourth quarter. We end just shy of 400 billion in total. I think here, right, as we look at new issue supply, we had on average through 2020 and 2021, on any given week, 9 billion pricing in the market. And as we look at 2023 and navigating that volatility, new issue supply on average was about 7 billion per week. But I think what was most helpful and constructive to the efficiency of our market was that we didn't often see consecutive weeks in excess of that weekly average. Or if we did, it was often followed by a reprieve and an opportunity for that supply to more appropriately make its way through the system. New issue projections this year range on the low end of 330 to as much as 450 billion, with most expecting about 400 billion, which I think would be welcome given the last 2 years just below each of those totals. I think most notable also, and here's something we'll be following as we make our way into 2024 also, is that the muni market in 2023 priced 28 deals in excess of 1 billion, right? So issuers issuing, the larger issuers issuing a lot of bonds. That surpassed 2022's total of 24 deals in excess of a billion, and beat the previous record, which was in 2020, not surprising, of 26 deals in excess of a billion. So what we've been seeing is that the larger issuers continuing to access the market despite the rate environment and that volatility. But I think investors, the other side of that is investors naturally gravitating to the largest deals and those with the highest ratings amidst this market volatility. The bottom part of this page here, I think, too, helpful to our supply picture as we made our way through 2023 with that big roundabout end rates mostly ending the year unchanged, is that we end the year with negative net supply. That is more bonds being called or matured than bonds being issued in the market. And so as we look at this chart, we often saw the strongest demand at the beginning of the month, naturally matching with the urgency to put money back to work in the municipal market. And then we also see the strongest reinvestment period in terms of those bonds being called or maturing in the summer months. And so we saw new issue supply kind of match up with that as well. And I think that tailwind in leveraging that technical is something we'll continue to make our way through as we begin 2024. The other side of the technical equation is the demand component. And so we've certainly seen a market shift over the last couple of years, right? Separately managed accounts now hold more than 18% of all municipal debt. That's up from 15% just a couple of years ago. And, I think here, the shift from true individual retail to institutional aggregators is one that continues to keep, I think, rates in particular in the front end at bay. I think we've also, and I think as you look at this, the shift in holdings also, we've seen a lesser a degree of interest from bank portfolios, not surprising, particularly following the first quarter of 2023, and then insurance companies less active over the last couple of years or so. Municipal bond mutual funds historically have been a significant player, and they continue to be despite the fund complex being challenged by outflows. And you can see that on the bottom part of this page. We saw outflows slow in 2023 in total, about 15 billion leaving the fund complex. That compares to 80 billion in 2022. So an improvement there overall. But what I would say about municipal bond mutual fund flows is that the depth of demand was often challenged as we were in the market with new issues, particularly as it relates to duration. And some of that was the rate environment, some of that complicated by how we saw money coming into and leaving our market. One of the follow-on results from a shifting in investor landscape and how we've seen the demand trends shift is that those separately managed accounts most often were their interest was concentrated in the front end of the yield curve. Historically, that had been the first 10 years. But last year, what we saw with an inverted yield curve and an inverted yield curve in the municipal market as well, we saw those separately managed accounts extending out past 10 years, most often through at least the first 15 years. So I think that's something to be mindful of in terms of creating competition, right? You have the separately managed accounts as the layer and foundation, and then bring in the other types of buyers to kind of build upon that momentum. And that was a strategy that took hold throughout much of the year. The other thing here too is that while we saw only 12 weeks of inflows overall, 40 weeks of outflows, perhaps it was also a shift into a more defensive or conservative approach. We saw money market funds, with elevated yields and assets moving into those or even short-term treasuries as well. And then lastly, I think additional context surrounding the size of the market. I think this context is helpful, particularly when we're considering taxable new issuance, right? And corresponding supply within the corporate market as it compares to the municipal market, and what potential impact that might have on credit spreads, as the other side of the rate environment. And so just helpful to be mindful that our market's a $4 trillion market, where outstanding in the corporate bond market much larger, north of 15 trillion in total. So I've talked a good bit about the technicals in the muni market, and as I started out by saying, it's a strong driver of performance and really ultimate engagement. But the fundamentals in our market remain really strong. And so as we look at the rating agency outlooks, beginning with Moody's, suggesting that, what the data is telling us is that the U.S. consumer is resilient, even in the face of elevated inflation. For all sectors within the muni market, the outlooks remain stable, with the exception of mass transit, understandably so. S&P overall projects a shallow slowdown, not a recession, which should be manageable and not create disruption as we navigate the change. And then Fitch suggests really what has been unfolding since COVID, right? Healthcare, life plan communities, higher ed might face challenges due to cost pressures, but perhaps also due to declining enrollments as we begin our way into 2024. All generally pretty positive outlook. So that's something to lean back on alongside the technicals in our market as well. I think the technicals are reflected in their ratings across the board. Moody's in the fourth quarter of 2023 saw the 10th consecutive quarter of upgrades outpacing downgrades. And so a positive backdrop as we continue to make our way forward. a couple of things, right? Looking forward, understanding the market backdrop is helpful in the rate environment, and what you in it as we develop our strategies. But I think here, I was thinking about, gosh, what did we learn, right? What are our takeaways, and what can we do to help position issuers as we look to get into the market, understanding the current situation. So, the current situation, fighting the Fed, where the Fed continues to be on the forefront of, where things are going. Overall, higher rates are here to stay. In navigating that potential volatility or impact of volatility, the one thing that we saw through 2023, it might be helpful as we make our way into 2024, is kind of avoiding that event risk, right? Investors sensitive to the direction of rates, how things will be looking forward. And so what we saw at some points last year was avoiding big days, or beginning, to get into the market following the news. Avoiding days where the Fed was meeting, or if you had inflation data that was going to be impactful to the direction of rates, perhaps letting the reaction, which was often the initial reaction was often an overreaction, letting the reaction make its way through the market before entering into your order period, or before confirming the levels in which you were going to get into the market, was certainly helpful. Volatility overall, we saw that intraday movement within the Treasury market, municipals following the direction of that. Again, getting back to a timing situation was pretty helpful there. And then lastly, and I think the bond bank did this exceptionally well, in particular on the last deal, is following where the demand is, right? Here, as we talk about investor preferences, whether that be, coupons shifting from, the 2% and 3% coupons we saw through 2020 and in 2021 to a more defensive strategy, to engaging where that strongest demand was with the separately managed accounts, structuring deals in those earliest maturities, where you were able to bring together different types of investors, create that momentum and competition, leading to efficient pricing, were all of the things that we were putting together. And then, one last thing as it relates to the current situation, whether it be market volatility, investor dynamics, or really just positioning the bond bank to get into the market, is what we found is that the pre-marketing period leading up to pricing was often most impactful to continuing to engage investors as we were making our way through these rate changes, right? If you're able to bring investors along in the earliest part of the process in terms of timing, and what the financing goals are, they're potentially more likely to continue to participate despite the noise or the backdrop of the market that continues to be challenging. So that's something also that could be a great strategy in navigating the landscape as we make our way through 2024 as well. And so here we are beginning 2024, looking ahead, and thinking about things that will impact the market. We're looking at a few different scenarios, geopolitical risks at the top of the list here, the spread of the conflict between Hamas and Israel on the forefront, continued unrest with the war in Ukraine. And as the year progresses, we'll be more appropriately following the potential policy implications that could come from our presidential election in November. Beyond the geopolitical concerns, in what was the focus, as I mentioned, in 2023, economic data and central bank policy. The Fed's dot plot in December suggests rate cuts in 2024, and you can see I've put it here in the top right-hand chart. Inflation peaked in June of 2022. moving from, north of 9% to just north of 3% currently, with the 2% target being the Fed's focus. And so here we are with the market having a lot of good news priced into it currently. But it seems that what the market is pricing in and what the Fed is suggesting as their path are a little bit at odds with each other currently, right? We've got market consensus, if you will, and this continues to change, suggesting a rate cut as soon as March, but the Fed notes that inflation is still above its target. Higher for longer is the mantra. And while the market's suggesting potentially 5 or 6 rate cuts this year, the Fed is only communicating 2 or 3. So, there's many Fed presidents that believe that rates should remain above 5% through 2024, while we begin getting more acceptance just below that 5% level the second half of the year, and seeing improvements towards lower rates 2025 and beyond. The bottom chart is just another way, certainly, to look at that. And, I think one thing I caution here too is that the market, right, as the market and the Fed are at odds with each other, has been overly optimistic on Fed policy over the last year or so. So certainly something to follow as we continue to be fairly data dependent. And then, further, as we look ahead to rates and the economic outlook, we certainly recognize the labor market strength. It remains strong. We got a better than expected December payroll number reported at the beginning of this month. Last week, we had stronger than expected inflation data with CPI, only to be tempered by a cooler than expected PPI number the next day. Yesterday, we had retail sales rise more than anticipated. The largest monthly gain since September, year over year, rose by 5.6%, and the largest annual increase since January of last year. The consumer remains exceptionally resilient amidst all of this. And so the bottom line is that the notion for a resilient consumer and more broadly solid growth moving forward. And what does that mean, right? For the Fed, an unwavering consumer, despite a 525 basis point move towards higher yields, supports the prospect for a soft landing, which is what we've been talking about all along. But it also suggests that perhaps monetary policy hasn't gone far enough to slow that growth. And so that's where the market, as I described, being at odds with each other in terms of when that first rate cut is going to take place, will continue to unfold. We've heard from a number of Fed presidents this week trying to convey a balanced message of avoiding an overly restrictive policy for longer than necessary, while at the same time avoiding a preemptive reduction in rates before we've gotten to price stability at that 2% target overall. So at this point, with growth surpassing earlier expectations as we begin the year, it leaves us, I think, with the need for more data to fully understand the direction forward. And so, as you look at the market consensus for a probability of rate cuts and hikes moving forward, 69%, and this was just as the other day, we're just below 69% for a March cut moving forward, and perhaps it more appropriately aligns towards the second half of the year. As you look at the market consensus in terms of yield curve projections here, I think the market seems to be looking for factors to sustain where rates are today, right? As you look across, looking at 10-year Treasury yields, the market consensus paints a picture for a tighter trading range, which I think we would all welcome, coming off of that unprecedented volatility. But I also think when communicated to the market in transparency from the Fed, continues to be paramount to our path forward. We'll continue to follow that more closely. But you've got 10-year Treasury yields, as I printed this, just below 4%, north of 4% today, and yesterday following that retail sales number. But if we're within, a 25 basis point trading range or so, I think that would be welcome overall from the market. So I guess maybe one last thing, right, as we conclude, I'm going to leave us with this. I've talked a lot about the direction of rates higher for longer, and while volatility continues to be a defining theme, perspective is pretty important. So while we've come through, 11 rate hikes over the last few years, rates have been higher than where they are today, almost 90% of the time, going back to 1994, right? So as we talk about a move towards higher rates, we still find ourselves in an opportune time to access the market. And as we make our way through 2024, I'm really optimistic about the performance and engagement within the municipal market and the prospect for supply to come back online and perhaps reach that 400 billion mark. So maybe with that, I know I've covered a lot. Michael, I'll turn it back to you and the group for any questions or comments.
Great. Well, thank you so much, Betsy. For the audience, please put your questions in the Q&A. I'm going to kick things off with one question I've had for our borrower community and some of our local investors. One of the more significant events to occur in the municipal market was that Citigroup, a major institutional bank, international bank, and considered to be amongst the largest banks in the country, closed their municipal market practice. Alongside that, perhaps driven by the SMA activity that Betsy mentioned, there's been a preference for larger and more highly rated deals. And I'm just wondering if you can speculate on what this might mean for the market in terms of liquidity, and also for issuers like the bond bank that are, aggregate deals, but are on the smaller end as compared to, say, a state of California or something.
Sure. So all great questions. And, the market impact, Citi exiting the municipal market, and they've been very active and a top underwriter and liquidity provider for as long as I've been doing this. And so the impact of having them leave the market is one in which I think there are certainly a number of dealers that can make up that void, but navigating that in its early days will be something we're following, and we're certainly working with investors on that. I mentioned this in my comments, right? And you get to it here in your question is liquidity amidst market volatility continued to be the focus. And so the bond bank structure is one that, despite being smaller than the billion-dollar deals that I mentioned, is one in which I think investors appreciate, right? Participating in new issues in the state and having it be larger than the individual issuers, I think is one where you're able to capture a lot of that. Separately managed account interest through, the first 10 to 15 years, impactful overall. And then as we make our way out on the long end, I think that momentum providing support overall, if you're able to demonstrate a market clearing level, a good bit of momentum, brings in perhaps some of those larger investors and larger funds that would not necessarily look at a smaller deal, but because of its success, because of the rating, the strength of the ratings, and the strength of the credits, you continue to outperform your peers in the market. And so that's what I would expect for the bond bank moving forward as well.
Thank you. Question from the audience here. This is more on the credit side. certainly, but something we experienced in Vermont, this past summer with the flooding is the awareness and price sensitivity to environmental risk. Um, you sit in California, places like Paradise, California, have obviously been in the news. I wondered from your seat at, more on the pricing side, what you see in any observations.
Sure. And so climate risk, right, as we have it, I think is a focus moving forward and will be um, impactful and important to credit decisions, if you will. And I think it'll become if it hasn't already for some, it will become a metric and part of that credit approval process, right? So engaging investors early on in that process to describe the backdrop of here's the potential risk, here's how we're working to mitigate it, will give them comfort in kind of navigating those environmental impacts within various regions. We certainly encounter that a fair bit out here with fire risk. Seawall, in particular in San Francisco, an important consideration, and I think the same holds true as well. So, having the response for what happens should we continue to encounter those challenges, I think is the way to get around that.
Thank you. Another question from the audience, a very hard one, but obviously this is coming off the 2020 election. There's uh, even more question marks around the 2024 election, and short of Fed actions, how the market might react to political volatility domestically.
Sure. So I think, again, the initial reaction will be one where we see, if it's not clear in particular on the direction of where Washington is headed, we'll see volatility surrounding that. I think specific to the municipal market, it'll be based on policy, right? Whether that it's tax policy in particular and kind of where Congress is on that too, will all be things we'll be following, hopefully with more clarity as we make our way into October and the beginning of November.
Back to me, taking advantage of the opportunity to ask a
Sure.
smart person some questions. One of the interesting things for the bond bank is that when we talk to the rating agencies, oftentimes the trends that we're observing in our small state are mirrored nationally, even with larger municipalities and states. And one of the things that we're observing this year is a significant uptick in new money activity, so new project spending across the state. And while the estimates for supply this year in terms of bond issuances are at or below historical averages, if we do see a large uptick in issuance, what does that mean for municipal rates? What does that mean for ratios?
Sure. So we start the year, right, with rates having moved so much lower, right? And so the question is, did the market get ahead of the Fed, and did rates move so much lower too quickly? So we have ratios, municipals appearing extremely expensive relative to our counterparts in the Treasury market. I think as you look to get into the market and what impact supply has on rates. I mentioned this as we talked about the supply picture. As we look at where that weekly average is, if we have, you know, 3 2, 3 weeks above that weekly average, um, we'll follow where credit spreads are, and if that starts to put pressure on credit spreads, perhaps being thoughtful around that timing, is helpful, right? As we look ahead, and have, issuance make its way through, the market efficiently. Ratios important, I think important in particular out on the long end, right? Where that duration being challenged overall, and you've got ratios through 90% of 30-year treasuries, which suggests that municipal is out on the long end, not fairly valued. So that'd be something to follow as well, particularly as you look at different structures. But um, I think that, again, the way to mitigate that potential supply risk, if you will, putting pressure on spreads is that pre-marketing period. That investor engagement early has proved successful in periods of increased supply, simply because those investors, create their list of what types of deals and what credits they're going to follow. And if they're engaged early on, they're able to plan more appropriately for full participation as you look to get into the market.
Thank you. So looking at the list here, no additional questions. So we'll just leave you with a softball, which is, what's your favorite place to go back to when you come back to Vermont?
That's a great question. And so I love coming back to Vermont. My family's on the East Coast, and so I come back a fair bit, and I would be hard pressed to say anything other than Burlington. I spent 4 years there, a number of summers, despite spending a number of weeks interning in Montpelier and in Brattleboro. It's always great to come back to Burlington.
Well, we can't wait to have you back. And with that, we thank you so much for your time today, Betsy. And for the audience members, we'll post this on the website within the next day or so. Thanks for joining, and stay tuned for our both our upcoming winter bond issuance as well as our I guess spring or sorry, our summer market update in a few months' time. Thanks so much. Take care.
Thank you.